the topic of energy security. It is one of the key topics for as the energy transition starts to gain pace, but also, there's we need to make sure that we still have energy moving forward. So, how do we ensure security, but also maintaining a bit of momentum with the transition? Let's start off with that.
I can go ahead and start. I
Sure.
mean, in the presentation earlier, we highlighted a few different our traditional scenarios when we go long term, and we do that on a regional, on a national, on a global basis. And under all of our scenarios, fossil fuels will continue to play a role for a while. I think we have capital stock that isn't that easy to transfer out. Obviously, using existing infrastructure is an easier short-term solution as you slowly develop longer-term solutions. Actually, if I could pull up one, if I was to pull up one of our slides earlier, the big absolutely electrification is the story of energy transition, and the bulk of that electrification is renewables. But if we look at the role of gas, for example, it is remarkably resilient across all of our scenarios. We definitely see oil being impacted by the electrification of transport, and supported by non-energy uses such as petchem, but natural gas as well. Feedstock use or energy use, it's an area of growth before it becomes an area of decline.
Yeah, I should disclose I run a gas company, so I do have a somewhat biased view on this. But I think if you look at the role of gas in, first of all, in decarbonisation over recent years, it's played a critical role, particularly in this country where shale gas has become so plentiful. It's driven energy prices down, and it's actually displaced coal from the system to a great extent. And also, gas, is a critical complement to renewables because it's dispatchable, and so as you deal with the intermittency of renewables, gas is a critical partner. In my own country of Australia, where we're seeing this, where we actually have a relatively new federal government, a Labor government, which is sort of the equivalent of the Democrats in this country, and we have been through a pretty painful period in our country over the last couple of years where gas prices reached extraordinary levels during the Ukraine war, largely because we are a very export-driven gas market in Australia. And so as LNG prices spiked, domestic prices spiked too. The government was forced to intervene in the market, which did impact investor confidence in the Australian sector. But just in the last couple of weeks, our government has released what it calls the Future Gas Strategy, which confirms that role of gas for a long time to come, and certainly well beyond 2050. So, we as a company, I think, foresee that there will be a very important role for gas for a very long time to come.
Okay, great. So I suppose, moving forward, looking at that kind of, maybe we can get a little bit deeper into that future energy mix and what you foresee is kind of all of the various components of energy kind of coming together moving forward.
I mean, I can go ahead. I mean, we've got the incumbent energy sources, which have been around for a while. I think when you look at the introduction of new sources, if you look, I'll say the obvious thing that energy has been transitioning forever. The time it takes to go from like a 2% of the total energy share to a much higher share, usually this is in the span of decades. It certainly is being accelerated right now in terms of renewables, I think. But the thing to keep in mind when you look at the total energy share and even the total emission share, electricity is currently, the power sector is only one of the segments. You still have residential commercial uses, industrial uses, transportation uses, which are major energy sinks, energy sources of demand. So, you know, we have where we are now, and we see this extraordinarily growth in renewables, which is decarbonizing the electricity sector. We see an electrification, where we see electricity replacing liquids and gases in certain applications. But then again, there are, to use another cliche phrase, there's a lot of hard to decarbonize sectors and specific feedstock uses where fossil fuels will continue to play a role. And some of that is feedstocks. So you're talking about emissions in the processing of, let's say, petrochemicals but not necessarily, we're not talking the combustion of the feedstock fossil fuels. So, I think what we've been calling it, and there's a regional element to this too. I mean, you can talk energy transition globally, but the fact is energy transition means something very different in China than it does in the United States. It means something very different where you have population growth and GDP growth of, either negative or very low single digits, to countries that are growing much faster. We look at India and the role that India plays in terms of population and in terms of potential and in terms of their expectations of energy use. So the stories are different in each case. And, whether you're talking Canada, which is which is a combination of a very hydro dominated power sector and otherwise a very industrial and mining oriented hydrocarbon and resource base, to a country like China, which is still extremely coal fired. I think the trajectories are different. The expectations and need for capital stock and investment are different, and realistically, the availability of technologies and investors is different. But I think probably everyone has things to add here.
Absolutely. So, Corey, just to catch you up, we're talking a little bit about energy security, but then also looking at the future energy mix and what you kind of foresee across the energy spectrum kind of moving forward.
Sure. I can talk to the nuclear side, uranium. I think from our perspective, security is critical at this point. There's a lot of geopolitical risk associated with uranium. Most of the countries that produce uranium actually don't consume the uranium. It's used by outside parties. And the fact that geopolitical risk is inherent, you look at things like, Russia, Ukraine, the fact that, China is building out, significant nuclear power means that a lot of the pounds that would normally come to the U.S. are now going eastward to China, which means that the U.S. is vulnerable when it comes to nuclear power, and so is seeking to find domestic sources. And the U.S. government has started to understand that even more strongly, starting with the Inflation Reduction Act, Russia, the ban on enriched uranium, and forcing U.S. utilities to look for opportunities within the domestic market, which is obviously positive for us. We are a domestic supplier of uranium, or near-term supplier of uranium to the domestic market. And when we look at the U.S. as the largest install base of reactors in the world, consuming roughly 50 million pounds a year, the potential production of all of the parties who can produce in the near term in the U.S. is roughly 28 million pounds of capacity, which means that you've got significant demand with supply which can't meet demand. So there's an opportunity for those who are in the domestic market to take advantage of that opportunity, but also at the same time, the U.S. has to find a way to facilitate production in the U.S. in order to secure supply.
Yeah, I think one thing that's important to note is that the use of all energy sources around the world is skyrocketing, particularly as economies around the world move into the middle class, and So, and to put that into perspective, I think there's about 1 billion people in the world who have virtually no energy. Then there's about 3 or 4 billion people who, on a per capita basis, use about the amount of energy that a household refrigerator uses, so very little. And then in the first world, a huge component of the wealth that we enjoy is access to plentiful and affordable energy. And I think these days, the amount of energy that we enjoy, the top 1 billion people in the world, it's about, for the amount of calories that a human burns, I think we've got about 75 times that per capita in machine-based energy. So, we've seen as the world goes through transition, and you have these huge increases in the amount of energy being supplied from, say, renewable sources. The percentage mix of hydrocarbons is actually not decreasing that much, because every source of energy's demand is going up so much. So we do face a huge challenge around the transition, and ultimately, I think what we need to focus on is reducing emissions intensity as a lot of these sources grow.
And I think if I just added something quickly to Alex's point there, I mean, at Carbon Streaming, we're selling carbon credits to companies that are looking to neutralize their carbon emissions. And one of the things that we're seeing, certainly from our corporate partners, is this massive increase in energy usage, particularly around AI and data center use. So even when you look at the corporate side, there's massive new draws of energy required. And I think for the corporations we're selling credits to, trying to generate revenue or generate power from clean sources is an incredibly important thing for them, but recognizing that they need power and they need a lot more power. And so it's this energy transition is a real focus for them, as they are looking to clean up their own energy use, but it's not easy to do.
I would just add to that. I think the focus on quantifying, measuring, and then thinking about the responsibilities around carbon intensity have been critical. I mean, I think recognizing the fact that we will have fossil fuels in place for a while, then the focus will end up being on, okay, if you're going to be producing, and let's understand what the carbon intensity of production are. The same thing actually applies to mining and minerals. There's going to be a focus on looking at the low carbon sources of energy, low carbon sources of materials. The interesting point when we think about how the markets are going to develop around this, ultimately, this will happen if it can be monetized, if people can respond to signals. Some of those signals come from pressures by corporates that have made net zero commitments, in which case they, whether it's SBTI or other types of approaches, there's obviously you can make the reductions yourself. You can try to, depending on the scope and depending on the categories, there's an ability to use carbon credits to account for some of that. But then also there's a question of the markets. Are the markets going to look to set a price on the carbon credits? I mean, the other way of doing things is actually to have differentiated commodity prices, where you have low carbon aluminum, low carbon steel, have that trade separately. When you think about how the oil market has developed, you actually have so many different grades of crude based on API, based on based on sulfur content and everything else. This is so I think we're at a very interesting stage in the market, because one stage will really be thinking about carbon credits and thinking how carbon credits can be packaged and bundled to achieve desired results. Another source of discovery in markets can actually be differentiated commodities, basically different grades of the same commodity based on their carbon intensities.
Absolutely. Do we have any questions from our audience before we've got one in the back?
Question for Corey. So with the potential uptake in SMRs, how do you see the incremental demand for uranium fuel in the United States in a conservative and then an optimistic case?
Well, I think the baseline right now is about 50 million pounds per year in terms of consumption. SMRs will once again, increase that demand, whether it's incrementally or not. We know that there's going to be further growth in the nuclear side in the U.S. So, subsequently there'll be more pounds required. The U.S. once again needs time to be able to, create a larger pool of processors, of producers, in order to meet that demand. So, it'll be a number of years before there's a match between demand and supply. And so I think during that period of time, you'll still see, I think there'll be a bifurcation in terms of pricing in the market. So you'll see a US price versus a rest of world price, just because demand within the domestic market will be so strong. And with that growth on the nuclear side, that demand won't be dwindling. So there'll be a lot of catch up over the next 20 years, and that price will continue to stay high on the back of that.
Do you guys have any criticisms of the IRA in relation to the energy transition, like things you wish you would have seen in there, or concerns that you have about it in relation to energy transition?
Who wants to go first?
Yeah. Well, sure, I'll jump in. I think like anything, there are always ways to improve, offerings. I think from our perspective, if you look at the nuclear space, a lot of the focus on the IRA was in looking at the nuclear reactor side and then working its way down. You can see that, nuclear reactors getting a lot of credits related to production, extensions, et cetera. And then as you move down that chain to enrichment, we've talked about the Russia ban of enriched fuel. And then obviously below that's conversion, which is another thing that will be addressed going forward. But then there's us. And so we'd ideally like to be able to access funds as quickly as those, above us in terms of how these things are tiered. So I think the criticism is not even criticism, but just what we've noticed is that the access to capital may not be equal amongst everybody. I think the fact that the domestic uranium production side is quite small, which means that it's going to get less interest to start. You want to deal with the big issues first and then kind of work your way through to the smaller issues. So from that perspective, it's a bit more of a challenge for us to access the capital as quickly as we'd like to. Although we understand the capital is there, we've seen a lot of monies flowing out to much larger entities, multi-billion-dollar entities. Ford plant getting significant monies, multi-billion-dollar investments, whereas we're looking for something a little bit smaller. So from that perspective, if there was a way to kind of split the market to understand that there should be pools of capital focused on each area, as opposed to having a large pool which addresses everything, but not necessarily at the same time, I think that's something that we'd be more interested in, or would have preferred.
I mean, I'll try a diplomatic kind of addressing it. But the IRA is essentially going in three different directions. One whole set of people see it as an emissions reductions effort. Another set of people sees it as an industrial policy effort. Third set of people see it as a security effort. So you have those three factors essentially kind of coming up against each other. Yes, you do want to have an uptake of electric vehicles, but then you want to make sure that is, that there's a domestic component to it. You want to make sure that there's not exposure to countries with whom the United States, wants to be careful in terms of dependencies. So, you had the initial law, and then since then you've had so many of the regulations by IRS and others defining the carbon intensities, defining, the specifics of what it takes to achieve the tax credits. So, how happy people are depend on where they are on the spectrum. I mean, I'll use the example of the hydrogen industry. The 45E tax credit came out much more restrictive than many in the industry would have liked to have seen, because they were stricter on the emissions side. Now, depends on, there are those that believe that you build up an industry first, and particularly a nascent industry, and that weren't happy with that. Then there were people on the emissions side that were very happy that you didn't have a lot of support going to an industry that couldn't demonstrate that it was emissions reducing right away. So it's like I said, it's a balance of those three things. There's the people who really thought that this was going to be what gets us to the US's NDC targets in terms of the Paris Accord. They would have liked to. They are pushing and would hope that many pieces of it would be more climate oriented. For those that are looking to build up nascent industries, probably would have liked to have less of a focus on near-term emission reductions. And for those that are really focused on energy security and geopolitics, they want to make sure that that the U.S. is not relying on creating new dependencies in terms of supply sources. So.
All right. So I thought we could look at go back to something that I think it was Roman might have been speaking about earlier. But looking at different differentiated commodity markets, but just kind of understanding what's going into a project. So I think one of the big things that investors are asking for is essentially transparency and understanding what the companies are doing. So ensuring transparency in projects and products. So how do you speak to the investors and kind of share what you're doing to get them to understand your projects and kind of where your operations essentially?
I can talk to that.
Sure.
I mean, so Empire Energy is developing an Australian shale gas project from a greenfields perspective, and fracking is a term that's not particularly well understood in Australia and engenders a lot of fear. I do wish sometimes that the Texans had coined the term stimming rather than fracking, but so we operate under an incredibly strict and transparent regulatory framework. We have to, first of all, we operate on Aboriginal land, so the native title holders own the surface rights to the land, and so we need their full and informed prior consent before we do anything, and also carry out extensive studies of cultural heritage, flora and fauna, understanding of even the way that water will move across our well pads and so on and so forth. And there are some in really world-leading environmental protections in place to protect the aquifers that sit about 300 feet below the surface, which is obviously a very important resource for all of the local communities and pastoral operations and so on. And the regulatory framework under which we operate is also extremely transparent in that any technical non-compliances we have to be reported immediately and are put up on government websites. And we're very proud of our environmental performance as a company, and we take it very seriously. But that transparent system is designed to ensure that less scrupulous operators don't misbehave. Mm-hmm. And also from an emissions perspective, so first of all, there's very low CO2 in the reservoir that we're operating in, but also under Australian federal regulations, we are required to offset all of our Scope 1 emissions, which we will be doing. So, in Australia, where shale gas is very new, we have really the highest standards anywhere in the world and operate under those, which is not only the right thing to do, but also it does help in terms of gaining financing when, particularly speaking to banks, for example, where mm-hmm. they have their own internal ESG requirements for our industry.
And on the carbon side, I mean, one of the things I liked about the space when we started the company about 5 years ago was of the 6,000 projects that exist in the carbon world today, the information is very transparent. You have separate audits and reports that are done by all the registries before carbon credits are issued on a project, and all of that information, the separate audits, the initial what we call PDD, so the project description reports are available. So, I think the carbon sector's been created with this idea of transparency and sort of ESG friendly investing. So a lot of that information is public and available, which we like a lot. One of the challenges though that we have, unlike the energy industry, is in carbon the price is what's actually opaque. And what you find in carbon projects is some carbon projects generate credits that are worth $2 a credit, and some are $2,000 a credit. One of the things we've struggled with from an investor standpoint is understanding the value of the carbon projects that we are financing, and that's not been an easy thing to solve, frankly. And I think with time, as liquidity and transparency comes into the market, hopefully that makes some more pricing information readily available for investors. But it is a market that's very transparent, and we know as we move towards net zero, we need hundreds, if not thousands, more of these carbon projects to be developed. And I think, again, as time goes on, some of that transparency will come to the market, which will be certainly beneficial. But now, when we sell credits to a corporate buyer, they're very secretive about what they pay and what they're committing to on the carbon side. Which, but at the same time, they want to be able to talk about the fact that they are supporting these, some amazing projects around the world to help lower their carbon footprint.
And in terms of the carbon prices, I mean, it's something that part of S&P Global is Platts, and we've been doing daily price assessments of different project types. We're kind of at a bit of a crossroads right now because there's a lot of industry initiatives, industry and national initiatives. I know that the U.S. government last week actually just announced a major initiative to support the voluntary carbon markets, and there's a stakeholder-led initiative which really is looking to ensure buyers and ensure sellers of a certain levels of quality that can offer essentially a stamp of approval. So, I mean, we're looking at that. We're looking at the next round at COP, which will give hopefully a global sort of framework, more of a global framework through what's called Article 6 of the Paris Agreement. Again, it can give you some of that fungibility, so that if you're a mining company in Australia, or if you're a agricultural company in Brazil, that there's a common currency depending on the types of credits. Now, the fact is there are so many other attributes, and it's a lot of times these are voluntary markets, so people want a credit that is local, that has sustainable development co-benefits. So it is an incredibly challenging pricing environment, which we'll admit to, but it's one that can offer interesting options going forward.
Yeah, I know it's not fair, but how do you deal with China and India, including your credit?
Yeah, I mean, I would say the buyers care, right? As Roman was saying, the buyers of these credits want credits that are homegrown, that are close to where their emissions are, and so you see this big bifurcation in the market of low quality credits and high quality credits. And what we find is almost unlimited demand for high quality credits, but for those low quality credits, there's actually oversupply. So we're focusing on what we believe are the higher quality credits, knowing that again, they're voluntary markets. Not every corporation is going to be buying credits, but as we move towards net zero, we see more and more companies caring about this, investing in this, recognizing that similar to Australia, the SEC is requiring disclosure of Scope 1, Scope 2, and even Scope 3 emission levels. And as that happens, it's likely to become a liability on the balance sheet for these companies. And so they're looking at ways to build assets to offset those liabilities. And but quality matters, and it's not, and as registries and methodologies evolve, and as core carbon principles and other factors come in to try and identify or better identify high quality credits from low quality credits, you'll just see buyers, I think in a lot of cases, just ignoring some of those low quality credits.
I think with the issue of China and India, it's a topic I mentioned earlier, is essentially some of the globalization of carbon, which is impacting actually iron and steel very quickly, is through CBAM. So you have Europe setting up a carbon border adjustment mechanism to try to protect this industry from the fact that they are facing a very high carbon price. The rest of the world isn't. What you're seeing is actually, China has a carbon market in place. It's much lower prices than Europe's prices, but India is in the process of setting up a carbon market. We're doing a lot of analysis to try to figure out how that's going to be impacting different sectors, including the mining and metal sector. Brazil also in the early stages of setting up a carbon market. So those are mandatory markets that are going to have to figure out how to fit in and interplay with the voluntary markets. But there is a sort of this globalization that's being really driven by Europe to some degree, and potentially by the Paris Agreement Article 6 to some degree, because you need that common currency. You need people to have faith in the common currency, and some of those systems are being developed currently.
All right. So as we're kind of getting to the end of the panel, I thought we could just look at the financing aspect. We are at an investment conference. So just kind of understanding, across the board and across kind of the different companies that we have represented here, funding is required across the spectrum. Where is the funding coming from at the moment, and where do you see the biggest gaps or opportunities for your companies and for the markets in general? Do you want to start?
Sure. In terms of the investments or the financing opportunities in our sector, and I guess specifically with the company, we talked about the IRA. We talked about opportunities from the government side. So the government side acknowledged that there is investment required in order to displace, potentially, monies that are more risky, geopolitical risk associated with uranium coming in from overseas. And so the government has put money to work. Department of Energy is looking at putting financing to work related to the processing side of uranium. Department of Defense is putting money towards the mining side of the sector. That said, it is government, so it doesn't exactly move quickly. And if we're trying to exploit and take advantage of the opportunities that are in the near term, the government money, once again, isn't readily available to the extent that we'd be looking to advance assets, for example. So we do continue to look at private investors. What we've noticed over the last 2 to 3 years is that a lot more generalist money is starting to move into our market. It is specifically, normally it had been a very niche market. Uranium is a very small market, and you had investors who had a specific interest in this one commodity only, who would be investing in the market, but there were only a handful of parties who would be doing that. And so now that the generalists are starting to pay attention to the market, there's a lot more available to us. So it's more private. It's not only U.S. but also Canadian investors. We have a fair number of Australian investors who are interested in the U.S. market, and European. So it's Western world, first world investments at the moment who have an interest in the growing market, and the fact that we're moving outside of the just the specific uranium only funds, I think is important to us, because it's an acknowledgement that this is a market that has the potential to grow, and is not only seen as a kind of a North American only issue, but one that has global impact. So from that perspective, we're seeing a lot more money flowing from all different parts of the world.
So, quick question on that. And maybe for the other panelists, as you consider the question, most of the generalist money coming in, what part of the cap stack is it coming in? Is it coming in as equity? Is it coming in as credit? And then the other question related to that, is it institutional investors that are coming in, or is it high net worth individuals that have just kind of they have a little bit of a risk bucket, and then they use the risk bucket to invest in commodities companies?
Well, it tends to be equity, and it tends to be both high net worth and institutional. So if you look at the sector in general, it's a very small sector. So a lot of the very large funds can't necessarily play in a lot of the stories that are within the sector, because they'll ultimately have to buy the whole company, for example, in order to make the size of investment required for their portfolio or their mandate. So the high net worth individuals have a greater opportunity to invest downstream in terms of the size of the companies within the sector. The institutions who are playing the generalist money tend to focus on the larger cap names, whether it's a Cameco or Kazatomprom. Once you get past those two names, that you're looking at companies like NextGen or UEC. So you're looking at kind of 3 to 5 billion market cap companies. So you have to look at where you are in that size structure in order to determine what type of investment will come in. But overall, the generalists are starting to pay attention. They're starting at the top and kind of working their way down. And so, we're starting to see that bit of a trickle down into all of the names within the sector. But the great thing about it is that you're getting the breadth of potential investors, as opposed to having to go into the same over and over again. And there's only so much that those investors can take of your investment opportunity. So we're seeing it, a growth, amongst all different types of investors.
Yeah. So our company has been funded principally through equity issuance through our ASX listing to date, and until recently, a lot of it was sort of high net worth to ultra high net worth investors. Interestingly, we're seeing a significant growth in the presence of US investors on our register, because they've seen how shale gas played out in this country, which has been incredibly successful. I think 70% of gas production comes from shale in the US now, and I think 60% of oil production, if I'm not mistaken. But Roman, you probably know the stats much better than me, so it's risky throwing out stats like that. In terms of sort of moving, like, we're rapidly approaching production, and once we move into production, a logical next step would be bank finance, but bank finance is getting much tougher. I spent 12 years of my career financing oil and gas at Macquarie Bank, a big Australian investment bank, which has taken a very pragmatic approach to transition and is supporting gas because of its important role in the transition. But I also spent a couple of years at another Australian bank called Commonwealth Bank, which is the biggest bank in Australia, and I think it's in the top 10 or 20 banks in the world. They got targeted heavily by activists where, I remember one day going into the Sydney office and Greenpeace had set up these bollards where you could either walk down a sort of a black and white entrance to the building with smokestacks and everything, and that was supporting Commonwealth Bank's dirty past, or you could then go through another column that had a coral reef with beautiful, colourful fish coming through. And, a lot of those commercial banks have just found it too hard. Mm-hmm. But interestingly, in the Australian context, a lot of the North Asian export credit agencies are now playing a big role because they need 30, 40, 50-year supply. And as an example, a big Australian company called Woodside is developing a major project called the Scarborough Project, and the Japanese export credit agency just provided them $1 billion last week. So, it's becoming quite geopolitically focused, I'd say.
Yeah, and on the carbon side, we raised all of our capital from high net worth and retail investors primarily back in 2020, 2021. Carbon's been a tough market to be in for the last couple of years, but as we look out over the next 2 to 3 years, we expect most of our capital to come from either corporate partnerships or private equity funds who are taking a view on carbon. Most believe that we're probably at a bottom in the carbon markets right now, and so the opportunity for us, we believe, is more on that private equity and corporate partnership side. We did just last week announce a partnership with Microsoft to reforest 10,000 hectares in Panama. And this was the first time that Microsoft has made a direct investment in a carbon project. They've done lots and lots of offtake deals. In fact, I think they've signed over $2 billion in carbon offtake deals in the first part of this year. But this is the first time that Microsoft's actually committed to invest directly in a project. And so I see carbon streaming doing a lot more of that in the coming years as we focus on carbon removal projects in particular, and that's just reforestation projects primarily.
And then just a macro question. So I think in your earlier presentation, it was $5 trillion needs to be spent to kind of meet the green CapEx requirements over the next decade. if you look at the macro picture, most of that capital has been dedicated to the front end of that supply chain, batteries, wind farms, solar panels. The back end of the process, see this from this conference, hasn't had a lot of demand from investors, largely because unfortunately metals and mining has had a tough slog over the last decade or so. And there's a lag time for when you can actually increase production. So where will the money come from outside governments, right, to basically meet that demand? And if that money doesn't come in to that sector, is that going to be a choke point for green capex generally?
It's a key question. I mean, I think when we look at, for instance, what the IRA has stimulated, there's a wall of private equity. A lot of it just goes to where it knows where to go. There are structures that are familiar. There are essentially wind and solar deals are super easy. Or, if you find the right one, they're super easy to do. There's PPA structures. Everything is understood. It's bankable. Even storage deals are a little bit harder because of some technology risk. And as you kind of go off that spectrum, it's like the river flows where the channel is, and there has to be another channel carved out, and there have to be, this is part of what LPO and Jigar Shah is trying to, part of what they're doing. They're putting the money into where the traditional debt finance wouldn't be going, or where it would be supplemented. We're tracking the flows in terms of the investments. We're looking at it. At this point, we're not seeing a disbalance in the next few years. Obviously, depending on how that plays out as we go further out, if there isn't a clearer lower capital cost pool of funding to build things out, this could potentially be a bit of a constraint, and it's something we can talk through. I mean, we've done some of the analysis around this.
So for the portfolio companies, would you take credit if it was available? So you've mostly funded your businesses through equity. So if there was an investor that had credit to fund your business, would you take it?
As a former lender, I'd say it depends on the terms. I mean, from our perspective, we have an existing funding line with my former employer, but we're in an appraisal phase, so we've got to be pretty careful about the use of debt until we start generating revenue, because money's sometimes easy to borrow and hard to repay. So, yeah.
I think from our perspective, we're going to be in production in the next couple of years, so I guess it all depends on terms too. We want to be in a position where we have a sight line into revenue generation, cash flow generation, in order to determine whether or not taking credit on would be too risky or appropriate. So we think we're at a position where we can make that decision, but once again, it does come down to terms.
Yeah, and on the carbon side, absolutely. I mean, we're a funding company, so as we start generating substantial cash flow, revenue and cash flow from a number of our streaming investments, I would say 2 to 3 years out, we would see ourselves taking at least a revolver to help finance new projects before you go back to the equity markets.
So I want to thank our panelists for joining us today.
Thank you.
Thank you.